Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Carnival stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Carnival Cruise is a cruise line with headquarters in Miami, Florida. It is a subsidiary of Carnival Corporation. Carnival Cruise is the largest cruise line in terms of passengers carried and total number of ships in fleet. It currently has 23 ships. This company is in an industry that has struggled during the 2020 global pandemic. Let's get started with the model. This is a large cap company, 23.9 billion market cap. They're trading at $21.66 a share, and they have 1.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has nice free cash flow in 2017 and 18. They almost have no free cash flow in 2019 and a big negative in the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have healthy net income in 2017, 18, and 19, but a big negative in the trailing 12 months. Their revenue was growing nicely from 2017 to 2019, but then it was cut in half. This is the company's income statement. The top line is the revenue, the sales. Below that is cost of revenue. And then revenue minus cost of revenue is gross profit. They had negative gross profit in the trailing 12 months. Their gross profit was really strong in prior years. It was growing from 7 billion to 7.9 billion. Then you have operating expenses, and below that is operating income. So they had a big negative in the trailing 12 months because they had such low revenue relative to prior years. Even though their revenue was so much lower, their expenses weren't that much lower. That's why they had such a big negative. Their operating expenses were just as high as prior years. So they did not do a good job at managing expenses. Below operating income is the interest they pay in their debt, and you can see that was really big in the trailing 12 months. Then you have other income and expenses, and then of course taxes, which are pretty low for this company. So their net income was really bad because of the coronavirus and so few people traveling and using their ships. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. So a lot of their CapEx are investments in their ships. And the way you calculate free cash flow, it's operating cash flow minus CapEx. So they had a big negative in the trailing 12 months. They had really low free cash flow in 2019. That's because they had a lot of CapEx that year, 5.4 billion. I'm okay if a company invests a lot in their business using CapEx, but if they had low operating cash flow, that would be a concern. In 2017, the company issued $500 million of debt, but paid off $1.2 billion. So they paid off $700 million of debt that year. In 2018, they issued $1 billion more of debt. In 2019, they issued about $2 billion more, and in trailing 12 months, they issued $11 billion more. They really needed the debt in 2020 because they weren't bringing in much revenue from their operational business. The company used to pay a dividend, but they cut their dividend in 2020. But another way to reward investors is to buy back stock. In 2017, they repurchased $500 million of stock, 2018, $1.5 billion, and 2019, $600 million. So when a company buys back stock, it lessens the shares outstanding, which gives you, the investor, a bigger piece of the pie. Operating cash flow is the most important part of a company, because if you do not have positive and healthy operating cash flow, you don't have much of a business, because you cannot rely on debt and equity financing to run your business in the long term. You need to bring in money from your operations. And they were doing really well until the pandemic hit, and of course they got crushed. And the way you calculate operating cash flow, you start with net income. That was negative 7.6 billion. And then you have to add back the non-cash items from the income statement. They had 2.3 billion of depreciation, 3.9 billion of impairments. They also had negative 2.6 billion of working capital. Changes in working capital are changes in accounts payable, accounts receivable, inventory, things like that. So even though they had negative 7.6 billion of net income, they didn't lose that much cash flow. They leaked about 3.6 billion of cash flow. But if things get somewhat back to normal in 2021, they may actually operate with zero cash flow. And then in 2022, they may be back to 5+ billion of operating cash flow if things go correctly. Let's look at a capital structure. 25 billion of equity, 11 billion of debt, and they're 69% equity, 31% debt, and their WACC is 14.8%, which is a blend of the cost of equity and cost of debt, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year that's 26 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $17 billion. We divide that by 1.1 billion shares, and we get a calculated stock price of $15. They're trading at $22, so they're trading at a 41% premium. It's a sell according to the model. Simply, Wall Street values the stock at $47, so they're saying it's undervalued. They're saying it's a strong buy. A lot is dependent on how well the vaccine does and how quickly people get back to traveling, and not just traveling, but using cruise lines. Some people think this is a dead industry that will never come back. I don't think that is true, but it could take a little longer than other industries to come back. The stock was fairly steady for a few years. It even broke through $70, it looks. But it dropped off a cliff in March when the stock market crashed. And it hasn't really come up too much, just a little bit since the bottom. So it's trading at a pretty big discount relative to its all-time high. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $6,100 today. If you did not reinvest the dividends, you'd have $7,400 today. The company has a really high beta, 2.24, so the stock moves more than 2 times the market. It's very volatile. In the past 52 weeks, the stock has gone down 55%, much worse than the S&P 500, which went up 16%. The low was $7.80. The high was $51.94. The stock is currently trading above its 50-day moving average and 200-day moving average, so it seems to be in an uptrend. This is a very liquid stock. 25 to 50 million shares are traded each day. In Yahoo Finance, it says it has 921 million shares outstanding, but that number is incorrect. It actually has 1.1 billion. And only 44% of the shares are held by institutions. A little more than 8.5% of the shares on float or shorted. The short percentage was probably a lot higher a few months ago, but the stock has come down so much, you don't make as much money when the stock is really low. You want to short the stock when it's high. All cruise lines were canceled in March 2020, and 55 passengers on Carnival ships died. Carnival has canceled many of its 2021 cruises. They even canceled some of the 2022 cruises. The company did offer a full refund or 100% credit towards a future cruise. Let's look at the financial ratios. The average PE in the market's 12, the median is 14.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 2.3, so they're doing better than the median and average. 2.3 indicates that investors are paying $2.30 for $1 of sales. Price to book is stock price over book value per share. They're at 0.9, so they're doing much better than the median and average. The way you calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on a balance sheet, and they have 25 billion of equity, 21.3 billion of tangible equity. That means they have about $4 billion of intangible assets on their balance sheet. If a company has a price to book value below 1, that indicates if they closed the business, sold all the assets, used that cash to pay off their debt, they would still have enough money left over to give each shareholder their entire share price, the $21.66. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. they can only cover 20% of their current liabilities with their current assets. Their current assets are $500 million of cash, $444 million of receivables, $400 million of inventory, and $671 million of prepaid assets. So the company is not well capitalized. They had negative $7.5 billion of free cash flow, and their working capital is negative $7 billion. They're going to definitely need some more debt or equity to run their business over the next 12 months. The best way to look at ratios to compare them to similar companies. I've done videos on Booking Holdings, Expedia, Norwegian Cruise, Royal Caribbean, TripAdvisor, and TUI, all in the same industry as Carnival. And if Carnival has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE. They do have a better price to sales and price to book ratio. They have a terrible current ratio. They have a really bad ROE. They're actually lower in debt than the average company. And their market cap is pretty close to average. And they do not pay a dividend. So to summarize, I do have them trading at a 41% premium. It's a huge unknown when their industry will get back to full capacity. But I think there's always going to be demand for cruise lines. And whichever cruise line can make it through the pandemic without going bankrupt should be able to prosper. But that could take a year, it could take several years. It's really hard to know. I suspect this company is going to go into more and more debt over the next year just to keep the business alive. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.